Welcome to Finance in 5. So further to yesterday's video, I felt moved to dive in more detail to the discussion of Michael Burry's Google call option. I mentioned that Burry purchased $113.1 million of call options in Google, which meant that he could profit from the price of Alphabet, its parent company, increasing in value. But why not just buy Alphabet shares, I hear you ask? Why are call options so much more lucrative? Is it too late for you to get in on the action? How do you make serious money? All coming up today on Finance in 5. So, welcome back. If you realize that no one is coming to rescue you, but you're interested nevertheless in being successful and in learning about what accomplished entrepreneurs and analysts are doing, and also if you enjoy financial information being made accessible and entertaining, then this is the channel for you. And while we've been talking, that like button has ripened and is now ready for smashing. And if you want to be particularly awesome and subscribe, that will be wondrous as well. So we've talked a lot on this channel about Michael Jeroboam Burry Sr. III Esquire, who I've admired ever since I learned that we share a penchant for wearing shorts to work. The investor, drummer, doctor, life coach, healer, writer of high-quality tweets, purveyor of heavy metal music, and so much more, just bought $113.1 million of call options, which is an awful lot. In fact, it's over 1/3 of Scion's liquidity.
That's pretty much all of Scion's liquidity. Michael, this is highly distressing.
Lawrence, that is not all of our liquidity. And I'm not certain that you really understand this trade. This is a certainty.
Mike, I consider myself a mentor to you, but our company is not comfortable with this investment. Am I being clear?
Lawrence, I have full autonomy when it comes to investment strategy. You can read our agreement.
Do not throw our inception agreement in my face, Michael. We had an underlying understanding you wouldn't act like a goddamn crazy man.
This is not crazy. It's all very logical.
So now we pay out premiums? In other words, we lose millions until something that's never happened before happens?
That's correct.
Let's start by defining call options. Call options are a type of security that give the owner the right to buy 100 shares of a stock or of an index at a certain price by a certain date. That certain price is called the strike price, and that certain date is called the expiration date. A call option is defined by 4 characteristics. There's an underlying stock or index, there's an expiry date of the call option, there's a strike price, and the option is either the right to buy or the right to sell, a call or a put, respectively. But we're only going to be talking today about call options. It's called a call because the owner has the right to call the stock away from the seller. It's also called an option because the owner of the call option has the right, however not the obligation, to buy the stock at the strike price. So the owner of the call option, also known as a long call, does not have to exercise the option and buy the stock. If buying the stock at the strike price is unprofitable, the owner of the call can just let the option expire worthless. The most attractive characteristic of owning a call option is the fact that your profit, technically speaking, is unlimited, and your loss is limited only to the amount that you paid for the option. Since owning a call option is always cheaper than owning the stock itself, when you know or suspect extremely strongly that a stock price is about to move up, it's always more profitable to own a call option on the stock than it is to own the stock itself. I will explain why. So, let's imagine you think a stock price is going to go up. There are 3 trades that you can do to make profit from a rising stock price. 1, you can buy the stock. 2, you can buy call options on the stock. 3, you can write put options on it. We've already said that we're not going to talk about that in this video. So you either buy it or you buy call options. Why is buying call options better? Well, let's look at this example right now. Imagine for a moment that Yahoo was priced at $40 per stock, and you think that Yahoo's stock price is going to go up to $50 in a few weeks' time. You want to profit from this expectation. So how do you do that? Well, you would buy 100 shares of Yahoo today at $40 and sell in a few weeks when it goes to $50. But if you were to do that, it would cost you $4,000 today. When you sold the 100 shares of Yahoo stock in a few weeks, you'd receive $5,000 or a $1,000 profit and a 25% return. It sounds great, but you're putting a lot of money down, and it isn't as lucrative as call options, as I'm going to demonstrate. Here is how. You buy one call option contract of 100 shares of Yahoo at a strike price of $40, which expires in a couple of months. For now, let's assume that this call option is priced at $2 per share, or $200 per contract. Each option contract covers 100 shares. So when you see the price listed as $2, you need to think $200 per contract. So this call option now gives you the right to buy 100 shares of Yahoo at $40 per share anytime between now and the third Friday in the expiration month.
This was a profit center. It was a profit center. It was something the organization wanted to do.
Always remember that in order for you to buy this call option, there has to be someone willing to sell you it. People buy stocks and call options believing their price will increase, while sellers believe just as strongly they will decline. One of you will be right, one of you will be wrong. You can either buy or sell call options. The seller has received a premium in the form of the initial option cost that the buyer pays, in this case $2 per share. So the seller receives some compensation for selling you or me the right to call the stock away from him if the stock price closes above the strike price. So let's imagine Yahoo goes to $50. Our call option to buy Yahoo at a strike price of $40 is priced at least $10 or $1,000 per contract. Now you might say, why $10? Well, because you have the right to buy shares at $40 when everybody else in the world has to pay the market price of $50 because the shares have gone up in value. So clearly that right is worth $10 per share. The option in that case is said to be in the money, or it has an intrinsic value of $10. Remember, money spent on call options is just a premium to control shares. You don't actually own any physical shares until the contract expires, or until you exercise your contract and sell them. You're betting on the price moving up. That's the reason why the graph crossing through zero here is key. For you to recover the $200 you spent on this instrument thingy, the shares at least have to reach $42 valuation by the expiry date. If that happens, you break even, but you're not in profit until it moves up higher than that. So in exchange for the money you spend on call options, you don't receive anything tangible like a share, but you do get control. The advantage of call options is that you get control over more shares per dollar invested that you spend than you would if you bought shares. So in the above example, it costs $200 to control 100 shares. If you just bought shares, you'd only get 5 shares because they cost $40 each for your $200. That's why it's a leveraged bet. So when trading the $40 Yahoo call, we paid $200 for the contract and sold it at $1,000 for an $800 profit on a $200 investment, which is a 400% return, not bad. In the example of buying the 100 shares of Yahoo, we had $4,000 to spend. So what would have happened if we'd spent that $4,000 on buying more than one Yahoo call option instead of buying the 100 shares of the stock? We could have bought 20 call option contracts at $200 each, and if we'd done that, then we would have sold them for $20,000 for a $16,000 profit. And this is how you should conceptualize Burry's bet on Google. We don't know how many shares he bought with the option contract or when it expires, but we know he spent $113 million.
So you made a ton of money?
Made a ton of money. Much more than I ever imagined, I'd ever have. We made $725 million, I think, on the funds in 2007.
In the example above, we pay $200 for the rights to buy 100 Yahoo shares for $40 at expiry. If the Yahoo share price goes up $10, then the call option goes up in value fourfold. The only out-of-pocket cost is the cost of the options contract itself, which is $200. This means after selling the option for $1,000, we quadruple our money. The same principle holds true of Burry's investment. Instead of $200 though, his out-of-pocket costs were $113 million for the Google call options, which remember doesn't mean that he owns those shares, but instead gives him the right to control X number of Alphabet shares. $113 million is a premium that he paid, which enables him to control the selling of X shares at an optimally profitable moment. This is a distinct difference, yet critical to understand. He might sell them in tranches. You'd have to ask the good doctor himself what he was going to do, but he might not tell you. Some of you think this sounds tantalizing. It looks like a much better idea than buying shares. You think equities are going to go up, why don't I just buy call options? I mean, you don't have to put as much equity down, you control more shares per dollar you spend, you can choose a time frame that suits you so that you don't have to get discouraged by short-term volatility, the ceiling on profits is potentially unlimited, la-di-da-di-da. The upside is pretty compelling, I grant you. The downside risk, however, is that the call option can expire worthless if the share price drops, which is why a good time to buy them is just after the type of market crash that we saw in March. The downside risk is mitigated to some degree if your initial capital outlay remains small compared to the value of the company's shares. In the case of a mega cap such as Alphabet with a high share price, you can invest relatively little and still control large numbers of shares. Many of you are already buying call options, in which case, good for you. There is a platform called TD Ameritrade, which is popular in the States for this very purpose. I tried to go through the application process myself last night, but was denied entry because I'm a filthy European. But I think that other platforms exist which are good, such as Plus 500 and eToro. They enable you to trade options in the UK. And similar platforms exist in other countries. I haven't done it yet myself, but check out this interesting piece that I read today. One analyst breaks down his thesis behind his Alphabet possible share price valuation target of $5,500 by the year 2030. That's an enormous share price. This guy basically compares Alphabet's continuing rise in value to oil, which historically has traded much higher. It says here, digital advertising is on an inexorable path towards $1 trillion spend by the 2030s. Alphabet finds itself serendipitously at the center of this trend via search and YouTube. There is an inexorable move towards extraordinarily high valuations in these cloud businesses. Every major business segment of Amazon benefited during the lockdown, whether it was retail, Prime Video, etc. And the same can probably be said for Google after the global economy reopens. I'm not trying to pitch Google to you. I'm just saying that it would appear that if you are confident on a bull run in a stock, I wonder whether Burry actually bought a range of options contracts that will have had different expiry dates and strike prices. Because my thesis is that Alphabet probably is a bullish short, medium and long-term investment. Short term for the recovery, it's gone back up 30% since April, but it's also poised to do well in the months ahead. I'd be very interested to know what his thesis is, whether he's just got out of this or if has he bought a number of different tranches of call options. It seems to be, it's almost like a black magic. It's very convoluted and complex, although maybe it doesn't need to be. Maybe it's actually simple to do call options trading. But I just thought I would speak a little bit about it, and if anyone is keen to just hopefully open up a discussion, really. If anyone's interested, leave a note, leave a comment. I will do more detailed research into this and we can talk about it more on a future episode. But for now, thank you again for listening, and I just thought I would post a quick update. Hopefully I'll see you again very soon. All the very best. Thanks.